All right, folks. Welcome to Elektronfx. And I thought it wise to give us some rules that will help our trading psychology. Many people, when you ask them why aren't you doing when you're trading, they always give one response: my psychology, my psychology, my psychology, my psychology. And it is one thing to know that yes, your psychology is the problem, but what are you doing about it, right? Some people don't know what to do about it because if you're maybe you're fat or you gained weight and you're trying to work on it, what do? You go to the gym, you watch your diet and all of that, right? But when it comes to psychology, there's no physical, let's say, there are no obvious physical activities in which we can use to improve our psychology, right? So people will be like, go for therapy. Does therapy help your trading? Maybe. But do we have such therapists in Nigeria? I don't think so, or where we are, right? So psychology has been proven to control about 80% of our success rate in Forex, right? Our trading mostly is governed by our psychology, our results, right? You may be very technical skilled. There are a lot of technical analysts, they know how to call the tops and the bottoms of the market, but still they cannot make money, right? Because of psychology, right? So psychology is 80% of what determines the success. Then you can now include risk management and then your skill to make up the remaining 20%, right? So when we talk about psychology, it is the holy grail, right? Or the brass tacks when it comes to trading, right? This is it, folks. So I'm giving you this. So when it comes to trading psychology, you're referring to your mental state, you're referring to your beliefs, your feelings, your emotions, and all those things that make up your thinking processes. So you're referring to your mind, your emotions, your beliefs, your impulses, and all of that. That's what psychology entails, right? So you can see that there are so many things involved in it. That is why you can find that when someone um, 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 is maybe sad or maybe has an emotional issue, he's bound to make losses because at that point, his inability has a kind of blindness, right? He's not able to perceive danger and all of that, right? So some people actually revenge trade. Maybe they fought with their spouse and you see them coming to the financial market to revenge on the market, and the market actually takes them out because the market is more powerful than they are, right? So when we're talking about psychology, we're referring to your mental state when you trade and how can you improve it, right? Since that is the holy grail of trading, all right? So a way to improve your psychology are just two simple ways, and those two simple ways have been broken down into 10 rules, right? The first way is to create rules that governs your actions when trading. That is how to help your psychology. You're acting as a like a servant to the rules which you have created, right? You create rules that are to your best interest, and then you have the discipline. That is the second thing. You must have the discipline to do what? To stick to those rules. After you have created your rules, all right, your rules, right, these rules that govern your trading plan, all of that, then you abide by those rules. Whether you feel like or you don't feel like, you abide by those rules to the letter, right? So now that being said, we can now go to what we have. So we have the 10 rules to help your psychology, right? To help your psychology, right? To help your psychology, and you will see results with this, right? So now, I want to say something before we go that. You must learn to separate your result from your self-worth. Your self-worth is how you feel about yourself, right? Or how you value yourself. The fact that you're making consistent losses doesn't make you a loser. The fact that you make consistent wins doesn't make you a winner. Your trading result should be separated from your feeling or how you see yourself. You may blow your account, it doesn't make you a bad person. You blew your account, you didn't kill someone, you didn't rob a bank, you just blew your account. That was only what you did. You did not rob anybody, you did not kill, you did not hurt anyone. Only thing you did was that you made a loss. So you should not see yourself worth depreciate, right? So you must understand that your trading result has so many factors that control it. It's not a derivative of your self-worth. So don't feel bad when you make losses. Don't allow those things get to you. You must learn how to separate your results from your feelings, right? You must separate your results from your sense of self-worth, from your feelings, from your emotions, and all of that. So trading must something will be done with strict rules and independence. So learn to separate the trading person, the trader in you from the person in the society. So For instance, my name is Geoffrey. I must learn to separate this trading Geoffrey from the Geoffrey that is known by his family members and all of that, right? I hope that is clear. So now let's go to the rules and then we can wrap it up, right? The first rule is that always allocate a risk percentage to all your trades, and the risk percentage should allow 10 trades minimum. That means if you have a $100 account, you should allocate your risk in such a way that you can take 10 trades, right? So it's not that you're risking 20%, because you're risking 20%, right? If you're risking 20%, you can only take 5 trades, and that is not wise. Believe me, you can lose all 5 trades and back to back, right? So it's better you go for 10%, 5%, 4%, 3%, 2%, any risk percentage that allows you to do what? To take at least 10 trades, because it has been proven, right? Go and watch my video on risk management. Just search it, risk management by Elektronfx, and I've proven over that it takes at least 3 trades out of 10 to be profitable if you are using a minimum risk reward ratio of 1:3. If you're using um, 1 3RR risk reward ratio, you need to make just 3 trades winners out of 10. So you can lose 7 and win 3 and still profitable, right? So using 1:4 is better. You can even lose more, but the goal is not to be losing all your trades, right? You must try to compound your account and improve your skill, right? So you must trade in such a way that you can take 10 trades without blowing your account. If it's $200 account, you can know how to minimize your risk. It's 5%. I usually recommend 5%. So 5% gives you 20 trades, and then you're able to know to to grow your accounts without blowing it, right? So allocate the risk to all your trades, and you should allow at least 10 trades, because I want to say something that trading is probabilities. So you might not actually know which trade may play out, right? So trading is what probabilities. So that's why you must do this. You cannot know which one will be the winner. The third trade might be the winner, right? So one beautiful thing about this is that when you're doing this, you can lose your first trade, lose second one, lose the third one, and then have the winner on the fourth one, right? But when you're using 1:3 risk reward ratio, this fourth one is going to do what? Cover what? This trade, because 1:3 simply means that if you're risking one, you have to make what? You're making 3. So if you lose 3 and you win one, this one win covers what your 3 losses. That is why you must trade with risk percentages and minimum and use your risk reward ratio, right? So now next is accept your risk. When you're trading, accept your risk. If you're risking $10, don't move your stops when price is about to hit it. Don't add positions in drawdown. If you're risking $10, let it be $10. If you're risking 5, let it be 5. Don't add positions. Don't move your stops up or down. Don't do it. That is how you keep your psychology in check. Not when price is moving, you now emotionally move it stop loss to the front, and then it hits you and then it passes. All those funny things. You can avoid that by doing what? Not moving stops, or do not add positions in drawdown, right? Don't do this, right? So we have gotten that. Now let's go to the next rule. The next rule is that you must take your profit as significant risk reward ratios or structural points. Do not look at your running profit or losses, right? So when you're trading, have a minimum risk reward where you take your partial profit or full profit, right? If it's 1:3, you take your partials, that is fine. Once price gets to 1:3, you take your partials, right? Always pay yourself, pay yourself. Don't just hold your trade for 5 days and then it comes and take you out and you do not make anything of it, right? So learn to pay yourself, right? So price gets to maybe double of what you are risking, you can close half. Just you must have all those things in your rules, right? Now, or you can use structural points. If price makes a new high or takes a liquidity, all those stuff, you can use the market structure or your charts to determine where to take your profits, right? So, and then most importantly, do not look at your running trade and losses, because when you're looking at this thing, you are bound to make a mistake. Maybe your profits grows to 500 and then it now start dropping to 480, start dropping to 430, start dropping to 300. When you're looking at these things grow and reduce, you're bound to what make a decision. Most times, the decisions are not what's in your best interest, right? Now, the next thing is learn to break even after once price gets the double of what you're risking, take your stops to your entry, because at the worst case scenario, price will take you out as break even. Break even simply means that it will take you back at your entry. No loss, no profits, no ties out, a no transaction, right? So nobody won, nobody lost. So once price gets to 1:2, take your stop loss to your entry, because at that point, you're protecting your equity. So because if price comes back, it's most likely going to take you out, right? So at that point, you're okay, trade has been moving your way. What do? You move it to your stop loss, or you take profits and then move it to your entry. That way you're psychologically okay, because you're not attached to that anymore. The worst thing that can happen is that you don't take a loss, but it hits your break even, right? So you must learn to detach yourself from the profits. So a running profit is not your profit. A running trade is not a one trade yet, and a losing trade is not a loss trade. So market can go in drawdown and still reverse. Market can go in profit and still come back. Just as said that the only profit that is yours is one that is in your capital or the one that's your equity, not the one that is running. All right. So now only take trades that align with the higher time frame. Right. This helps your psychology because short-term trades with a counter trend have tendencies of reversing at any time. So market can just sell a bit and then take you out. It could take you out at any time because it's against the higher time frame. So if you want to able to keep your psychology in check, take your trades are in line with the higher time frame. The BD1 4 hour, make sure it's in connotation or in alignment with your what by your trade, right? So only trade in line with the bigger time frame, not that you're trying to sell a bullish market or buy a selling market, right? These things help your psychology because if you're more confident to take your trade and then you can hold it, right? And then number 6, do not pick or select trades. Take your trades, every trade that aligns with your trade plan or edge. So if you have a trading plan or an edge or a strategy you use, you are not permitted to do what? You're not permitted to do what? To choose trades. Okay, I think this one will play. I'm not really sure of this one. How do you know that it's going to play or not? Are you at the back end of the algorithm? You don't know that. So whenever you're doing this, you must learn how to do what? Pick any trade that aligns with your checklist, take it, right? And use your risk reward ratio, use your risk parameters and all of that, right? You cannot know a winner beforehand and you can't know a loser beforehand, right? Now, unless you have maybe structural reason based on your edge that does not align. But once it aligns the edge, take your trade. Learn to limit your trading pairs to a maximum of 4. Not that you're trading EU, you're trading DXY, you're trading British pound against the United States dollars, you're trading USD CAD, USD CHF, USD ZAR, NASDAQ, US30, J30, you have USNCD. Oh my God. How are you able to focus on that? Right? Most of the traders I know that are successful are focused on few pairs, maybe 2, 3, 4, 1, 2, 3. Right. It helps you to be balanced because you're able to know what is going on the 4 chart. Because when you're trading on the few assets, you can tell what the market is doing and you have a better understanding of the market. So you have a psychology because you, for example, I trade EU a lot. So I can tell to a greater level of accuracy what EU is doing almost at every time. When we're trading like 5, 6, 7 assets, how are you able to cope up with what is going on this? If something is going on here, you can't even keep up, right? It's easier to maximize the trading when you're focusing on fewer assets, all right? So next thing, let your winners run. Stop monitoring your trades. So learn how to let the winners run. There's a popular adage that says, let your winners run, cut your losers short, right? So you must allow your winners run. So when maybe your trade gets to 1:3, you can close your profit maybe 50% and allow the rest run. That is why I said earlier that you should do what? Take trades with the higher time frame because higher time frame trades do what? Tend to do what? Have long runs. So if you're trading on that with bigger time frame, it has a tendency to keep moving a big number of pips, right? So retracements are usually shorter than the trend. So if you're catching a trend market, you are bound to catch what this big run. So take your profit and move your stop loss entry and allow it to do what to run, right? So now we have said that the ninth thing is have targets. It helps control greed and overtrading, right? There are situations where people will begin the day with maybe $500 profits in the morning, and before evening, they are left with what $20. $500 becomes $20 because they do not have targets. They don't have targets. So as a trader, have targets. Okay, today I want to make 1.5%. It's best based on percentage base. If your account is maybe 1,000, you can say, okay, today I want to just make 10% and I'm done for the day. Or this week I want to make just 30% and I'm done for the week. So that helps to organize your actions. You know what you're looking at for. Once you hit the target, you're off the market. It's true that the market is on 24/7, but you should not be trading 24/7. It's not done, right? Don't overtrade, right? So have targets. Once you hit the target, done for the day, right? And then know when to stop. Know when to stop means that when you're seeing yourself having consistent losses, or you're not thinking right, or maybe your mother annoyed you, your sister annoyed you, or you have one bid or something, just happening with you. At that point, I don't think you should be trading. You shouldn't be trading when you're having emotional conflict, you're busy, you're being distracted, you just have something that's just altering your current psychological state. At that point, you shouldn't be trading. So people actually have this habit of when something bad goes on in their family, they come to take out their vendetta on the market. Okay, the market did not offend them, someone else offended them, then they want to come and take out the vendetta on the market. And the market is bigger than their feelings. It's going to take the vendetta and deal with them. It's going to beat them and better together, right? So you shouldn't be trying to take out your emotions on the market, but the market is going to deal with you, guaranteed, right? And at that point, you can't perceive danger because you just want to have revenge. You want to feel better. Don't trade to feel better. Don't do it, right? And then another thing, no one to stop trading and or avoid trading. Avoid trading the news, avoid trading traps, avoid trading things that are not in line with your trend, right? That times the market gives inducements and those things are traps. Learn how to avoid traps and then avoid the news, especially red folder news events. Avoid it because you don't know what it's going to do. It could be a $50 profits before you know one candle you're in loss. So I don't think you shouldn't during your news. It helps keep the psychology in place because you know what to expect. So you are afraid of what you don't understand. So as long as you don't understand the news or you don't know what to expect from the news, you always fear. That's what's called the fear of the unknown. As long as something is not known to you, you are bound to fear it. Right? When you don't know the outcome of a particular news event, there's a possibility that you'll be afraid. And at that point, when you're afraid, you should not be trading, right? So I recommend a book to read, The Disciplined Trader by McDonald. So I expect you guys to read this book by The Disciplined Trader by McDonald, right? I expect you guys to read it. It will really help you by McDonald or trading in the zone. Anyone you see, right? So you can either choose trading in the zone or the disciplined trader by McDonald or trading in the zone, right? And then finally, I want to wrap up with this. I have a trading journal. A trading journal is where you write everything. When I mean everything, I mean everything, your thinking processes, your strategy, your risk reward ratio, um, your everything. So you should have a trading journal or plan, right? So trading journal comes in two ways. We have what we call the electronic journal and the physical journal, or let's say manual journal. The electronic journal controls what? The electronic journal controls what? It contains your charts, your analysis, your before, right before you take a trade and after you took it, your annotations, your study journals, what you are looking at, your backtesting results, and all of that. It helps to build confidence. When you see these things, you can study them. Maybe you're having a bad day. You can go back to your journal and see what you're missing. Maybe you've forgotten something or something, you didn't do it right. The journal helps to keep you what on track, right? And then the manual journal is where you write how the mistakes you made. Maybe after the week, okay, the mistakes I made, I should have done this, I shouldn't have done this. And then you're able to review your actions and then work on it, all right? And then in your trading journal, the manual one, you should have what your risk lot sizes you should use, risk management, risk of your targets, everything should be in the book, right? Learn to write everything, your feelings. Ask yourself, okay, I was feeling confident after I won that trade, and that's why I lost the next trade. Write those things down. So write everything down in your trading journal, and it's private, right? All right, so I hope this video was insightful. Do well to like this channel, subscribe, join the Telegram channel. If you want to join our mentorship community, still available, all right? So until next time, I hope this video was insightful. Give it a like, comment, join my Telegram community, and see you in the next video, right? Have a wonderful evening.